funding rates on meme coins going parabolic, a clear sign of rampant speculation. Crypto Twitter, the pulse of the retail market, was practically chanting no sell till 150K. Everyone was riding high, convinced the only direction was up, up, and away. Then, at precisely 8:42 p.m. EST, the world collectively flinched. Headlines started dropping like anvils. Former President Trump, in a move that sent shockwaves through global markets, tweeted the single ominous word, tariffs. This wasn't some vague threat. It was immediately followed by news of a whopping 100% levy on all Chinese imports, effective November 1st. This was the spark. Macro desks, those institutional players with their sophisticated algorithms and lightning-fast reactions, didn't hesitate. They hit the red button. Bitcoin, which moments before felt invincible, shed $5,000 in a breathtaking 8 minutes. That initial, gut-wrenching drop triggered the first wave of liquidations, wiping out a cool $2 billion in leveraged long positions almost instantly. Sounds brutal, right? But here's the real kicker, the detail that truly underscores the precariousness of the situation. Open interest on perpetual futures contracts was sitting at an all-time high, north of $52 billion. In plain English, practically everyone, from seasoned traders to eager newcomers, was levered to the gills, crammed onto the same side of the boat, convinced of the same outcome. And someone, with that tariff tweet, just screamed, "Iceberg." This wasn't merely a political announcement. It was a geopolitical earthquake that sent tremors directly through the highly interconnected and incredibly fragile crypto market, triggering a massive capital flight from risk assets. Let's really pull the pin on this leverage bomb. Most retail traders, when they hear 10x leverage, mistakenly think it means, hey, I can lose 10% of my position before I get stopped out. But that's a dangerous oversimplification, a fundamental misunderstanding of how these volatile markets truly operate. The reality is far more brutal. When a key support level like that $112,000 mark breaks, it's not a gentle unwinding. It unleashes a torrent of automated liquidations. Sophisticated algorithms, programmed to protect brokerages and exchanges, immediately target the most underwater positions. These forced market orders don't care about price. They just need to sell, slamming the bid, pushing the price down even further. And what happens then? That downward pressure triggers the next tier of liquidations, creating a terrifying, self-reinforcing feedback loop. Domino, meet gravity. This isn't just theory. It's a brutal reality that plays out in milliseconds. While CoinGlass, a popular on-chain analytics platform, officially reported around $22 billion in exchange liquidations, that's only part of the story. You see, a significant portion of the market operates in the shadows. When you factor in the massive volume from over-the-counter, OTC synthetics, and the rapid deleveraging by delta-neutral funds that operate off-book, the true scale of the carnage lands squarely on our $50 billion headline. The truly terrifying part? This entire cascade, this staggering transfer of wealth, took a mere 42 minutes from the first breach of support to the final, exhaustive flush. If you blinked, if you looked away from your screen for a moment, you likely missed one of the greatest, most brutal wealth transfers in crypto history since the FTX collapse. It was a stark reminder of the sheer speed and unforgiving nature of a hyper-leveraged market when panic takes hold. During that frantic, nightmarish 42-minute window, something else critical happened. Liquidity, the lifeblood of any healthy market, simply evaporated. On Binance, the world's largest crypto exchange, the order book depth for the BTC-USDT pair, a cornerstone of crypto trading, collapsed by a staggering 92%. Imagine trying to sell a significant amount of Bitcoin into an order book that's suddenly almost empty. It's like trying to drain an Olympic swimming pool with a coffee stirrer. As the chaos unfolded, Kraken users reported frozen withdrawals, with the ubiquitous, frustrating message "for maintenance" popping up. Coinbase, usually a bastion of reliability, saw its API latency spike to an agonizing 1.2 seconds, an eternity in high-frequency trading. When liquidity ghosts you like that, when the buyers disappear and the sellers are in a desperate rush, the concept of fair value becomes an absolute myth. Price discovery devolves into pure panic. We saw slippage on a mere 100 BTC sell order hit an insane $800 per coin. Think about that for a second. You're trying to sell, and you're getting $800 less per Bitcoin than the last quoted price. That's how a seemingly routine 4% macro move, triggered by a tariff tweet, snowballs into a terrifying 14% daily candle. And that's precisely how it obliterates anyone who naively believed a simple stop-loss order would save them. This brings us to a crucial side lesson. In a genuine black swan event, your stop-loss doesn't act as a protective barrier. It transforms into a market order executed at the absolute worst possible print, often far below your intended exit, leaving you with substantially larger losses than anticipated. It's a harsh truth, but one every trader needs to internalize. Congress didn't directly light this particular fuse, no, but they absolutely stacked the kindling, creating an environment ripe for disaster. The Clarity Act, a piece of legislation aimed at providing some much-needed regulatory clarity for the crypto space, had passed the House back in July. Yet, the Senate Banking Committee's draft, still bogged down in debate, hadn't managed to clarify the fundamental question: are most tokens commodities or securities? This persistent, maddening ambiguity is kryptonite for institutional market makers. They thrive on certainty, on clear rules of engagement. When they don't have it, they react defensively. All summer long, in response to this regulatory uncertainty, these market makers widen their spreads, essentially creating a larger gap between buying and selling prices. This might seem like a minor technicality, but it's crucial. When that tariff tweet hit, those wider spreads meant there was no cushion of resting orders, no robust wall of liquidity to absorb the initial selling pressure. Price literally fell through an air pocket, a vacuum created by institutional caution. And if that wasn't enough, we saw stablecoin USDE, a digital asset designed to maintain a stable peg to the US dollar, depegged by a shocking 38%. Traders in a desperate flight to safety abandoned crypto assets en masse and scrambled into actual dollars, turbocharging the bid-side vacuum and accelerating the downward spiral. So while regulatory uncertainty didn't cause the initial crash, it undeniably amplified its severity and ensured that the eventual rebound took hours, not minutes, to materialize. It laid the groundwork, making the market incredibly brittle. Now let's talk about the big fish, the whales in the crypto ocean. Our diligent chain analysts, the digital detectives of the blockchain, flagged a specific wallet cluster. What did they find? This cluster added a staggering $420 million in Bitcoin short perpetuals, essentially betting on Bitcoin's price to fall, exactly 36 hours before that fateful tariff tweet even dropped. Coincidence? Perhaps. But here's where it gets even more intriguing. That same cluster then withdrew 8,000 spot Bitcoin to cold storage, taking it off exchanges just minutes after the announcement. Let's translate that sophisticated maneuver for a moment. This wasn't just a simple bet. This was a calculated, multi-pronged strategy. By shorting heavily before the news and then accumulating spot Bitcoin at rock-bottom prices during the crash, they effectively hedged themselves into a delta-neutral arbitrage. They positioned themselves perfectly for the dump, then swooped in to capture cheap coins on the other side, essentially profiting from both directions of the market move. Now, is this inside information? Not in the traditional sense, because policy risk, while not guaranteed, is often publicly discussed and speculated upon. But it absolutely highlights the stark reality of how sophisticated players, with their deep pockets and advanced analytical tools, exploit leverage asymmetry. They understand the systemic risks, they anticipate the cascading effects, and they position themselves accordingly. while retail traders, caught in the emotional whirlwind, often get caught holding the bag, or worse, face the guillotine of liquidation. It's a masterclass in market manipulation, legally speaking, but a brutal lesson for the unprepared. All right, so we've covered the chaos. Now here's the silver lining, the crucial perspective that emerges from the on-chain data. Despite the horrifying $50 billion liquidation event, despite the market mayhem, something remarkable happened. Long-term holder supply actually increased during the crash. What does that tell us? It means the strong hands, the true believers, weren't panic selling their Bitcoin to exchanges. The weak hands, the ones who got wiped out, were primarily those playing with excessive leverage in the derivatives market, not those holding spot Bitcoin directly. The net result? Bitcoin's underlying blockchain fundamentals remained completely unchanged. The hash rate, a key indicator of network security and health, remained at an all-time high, showing the miners were still hard at work, unfazed by the price volatility. And within a mere 5 days, Bitcoin, with its characteristic resilience, had already reclaimed the $108,000 mark. History, as it often does, rhymes. Cast your mind back to the March 2020 COVID crash, a similar, brutal leverage purge, followed by an astounding 1,600% rally over the subsequent 12 months. These structural resets, while incredibly brutal and painful in the short term, serve a vital purpose. They scrub out the excessive leverage, they flush out the weak hands, and they ultimately set the stage for healthier, more sustainable uptrends. It's a painful but necessary cleansing process for the market. Hey, if you're finding this deep dive into market mechanics valuable, do me a favor. Smash that subscribe button. Seriously. I drop these on-chain alerts and data-driven breakdowns every single week, giving you the insights before the next liquidation wave even thinks about hitting. And yes, they are absolutely free. So how do you protect yourself? How do you not just survive, but potentially thrive during the next market cascade? It boils down to vigilance and smart risk management. First, you absolutely must monitor aggregate funding rate heat maps. These are your early warning system for market overheating. When you start seeing positive 80 basis points, that's 0.8% across the board on perpetual futures, it's a blaring siren. It means leverage is maxed out, everyone is aggressively long, and the market is incredibly fragile, just waiting for a catalyst to tip it over. Second, keep a hawk's eye on stablecoin premiums. If a stablecoin like USDC starts trading 2% above its par value on major exchanges, that's a significant red flag. It indicates that fiat currency, good old US dollars, is rushing for the exits. People aren't just selling crypto for crypto, they're selling crypto for cash, signaling a widespread flight to safety and a lack of confidence in the market's immediate future. Third, set up alerts for key support clusters, where open interest concentration exceeds $5 billion. These are the battlegrounds, the levels where massive amounts of leveraged positions are clustered. When these support zones break, that's when the algo knives come out. The cascading liquidations we talked about earlier, they're triggered by these breaks, as algorithms ruthlessly de-risk positions, pushing prices down even faster. Knowing these levels allows you to anticipate where the most violent price action is likely to occur. Look, risk management isn't glamorous, it's not sexy. But neither is waking up one morning to a zero balance in your trading account. Discipline and foresight are your best friends in these volatile markets. $50 billion liquidated overnight. Tariffs announced out of the blue. Order books hollowed out in minutes. Yet through it all, Bitcoin's underlying network emerged stronger, proving its resilience once again. The profound lesson here, one that echoes through every market cycle, is this. Leverage is a loan, and you will repay it. You'll either repay it with superior skill, meticulous planning, and disciplined execution, or you'll repay it with profound sorrow and devastating losses. There are no exceptions. So, Bookmark those 3 crucial warning signals we just discussed. Always keep some cash on the sidelines, ready for those air pocket days when prices plunge and opportunities abound. And never forget, in the wild world of crypto, the elevator down is always faster, far faster, than the escalator up. Drop your questions below. Hit that like button if this breakdown saved you from a potential liquidation, and I'll see you in the next video.